In this week's video, we'll discuss managing risk near an important bull-bear line of demarcation. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. This is a daily chart of the S&P 500 that we discussed in last week's video. We'll move quickly here. Support, potential support. We're holding there now. These are the fibs from this move here. Retracement from this low to this high. We held in this general area here with a Fed meeting coming next week. This really isn't the important area for risk and reward. These levels down here are. We know that if a 3-week correction or 3-month correction or a 3-year bear market is getting ready to kick off, at some point we have to stop making higher highs and we have to start making lower lows. So we have to close below 1980 in this area here for our concerns really to increase. However, if we move into this area here, we may make some incremental changes. Here, we would have to move much faster and potentially change our composition or allocation significantly. We'll head into Fed week with a flexible and open mind. This daily chart of the S&P 500 highlights the indecision that we've seen with the Fed potentially thinking about raising interest rates around mid-year. Point of the exercise, price is going to be a much better indicator here than anything that tracks momentum. Why? Momentum has clearly stalled, so price is either going to break down or momentum will pick back up. So we're better off monitoring levels and price here and simplifying until we either break in this direction or in this direction. There's no law of the technical universe that says a weak-looking momentum indicator can't improve, and that's why price is really the better gauge at this point. This chart shows us what appears to be a trend channel governing what is still clearly an uptrend. How do we know that? This here is a higher high relative to this high. This high is a higher high relative to this high. This low here is a higher low relative to this low, and this low here is still higher than these lows here. This is our trend channel, potentially with price still sloping upward inside somewhat of the indecisive mess that we've had recently. Point of the exercise, price moves into this area here, concerns increase. If we break these levels here, it's not as important because we're still in the upward sloping trend channel. This is potential support in this area here. On a closing basis, to make a lower low below this level, we'd have to close below 1994 on the S&P 500. This is where we would start to move away from risk at a much faster rate. In here, we still try to be patient. The daily chart of the broader NYSE Composite Stock Index tells us to keep an open mind about bullish and bearish outcomes. From a bearish perspective, we have a failed bullish breakout here waving yellow flags. From a bullish perspective, at this point, support has held as long as we don't break into this area here, or more importantly, make a lower low below these levels here. Some patience is in order. Not much new to report here in terms of trend strength and sustainability. We do have some of these slopes starting to roll over here. However, we don't have any bearish moving average crossovers yet. So here, blue, the fastest moving average, is on the bottom. It remains on top. Here, the slowest moving average, the dotted one, is on top. And here it's on the bottom. So the present day still looks more like this period here in 2009. We have potential support in this area here, and this is our same trend channel potentially on a weekly chart of SPY. While there's no question there are reasons to be concerned about the general market, there are also reasons to keep an open mind about upside. You can see healthcare here. This is a weekly chart. We're looking at the weekly trend. If you owned healthcare, there's really nothing alarming here about the relative trend. We noted on Twitter that there were some charts that were a little bit surprising. Here's one. Healthcare weekly in isolation was still able to post a gain in the last 5 trading days despite the weakness in the market. This has a full bore bullish look. The last thing it did was make a higher high. It hasn't made a lower low, and we still have blue above red, price above both, and the slopes of both are up. Contrast this look with the look of the same chart, weekly chart, and the same moving averages in 2008. This is our full bore bullish look. This is what a full bore bearish look looks like. If you're a bear, you want this look to start to morph into something more like this. This is telling us that this trend is still relatively strong. We're really not even getting yellow flags yet on the weekly chart of healthcare. Same concepts here. This is as of 3:10 p.m. on Friday, March 19th. Home builders relative to the S&P 500. This is an economically sensitive sector and also an interest rate sensitive sector. Still has a full bore bullish look, is showing a little bit of weakness here, but still looks healthy relative to the general market. If we look at the weekly trend of home builders in isolation, XHB was also able to eke out a positive move in the last 5 trading days, still has a bullish trend on a weekly chart. As you can see, home builders in the present day look much, much better than they did in 2008. Is it possible for this chart to morph into a look like this? Absolutely, positively, yes, but we need to see a little bit more, and this is also telling us that the bears, despite their gains in slowing momentum, still have some work to do. As of 3:12 p.m. on Friday, March 19th, also an economically sensitive sector, small cap growth, or the IWO ETF, still leading, outperformed the general market this week by 1.9% and may have done a little bit better than that by the close. This still looks healthy. Looking at the same ETF in isolation on a weekly basis, IWO still has a full bore bullish look on the weekly chart. It was up late on Friday afternoon for the week in the green. And you can see here the last thing that it's done is made a higher high. This is a higher low relative to this low, and this is a higher low relative to this low. The point of showing these charts is to say that the general market is still a little bit healthier than we might otherwise believe by just looking at the S&P 500. This is what IWO looked like in 2008. You can see price is below, blue and red. The slopes of both of them are down, and blue is below red. We have just the opposite today. Full bore bull look, price above both moving averages, blue above red, and the slopes of both are up. Could this chart morph into something like this? Yes, and that's why flexibility is still needed going into next week. But right now, this chart would make the surprising list. We might not have expected this with how weak the S&P 500 was during the last 5 trading sessions. Intuitively, if the economy was about to tank, we wouldn't expect IVW or S&P 500 growth-oriented stocks to be outperforming SPY, but that's what we have as of Friday, March 13th. This is the look of the weekly trend in isolation for S&P 500 growth companies as of Friday, March 13th at 3:16 p.m. How did this chart look in 2008? The answer, quite a bit different than it does today. Today versus 2008. Depending upon when you came on board as a new client, what your cash levels were, we added HEDJ to some accounts. Recently, it did well versus the S&P 500 this week, outperforming by 3.25%. It's possible we will add this position to all accounts, but we'd like to see what happens with the general market before making too many chess moves one way or another. This is HEDJ in isolation, and as you can see, this doesn't look like a position in terms of the observable evidence today that's in trouble. Another ETF on the surprising list this week would be XRT, or retail. Economically sensitive retail outperformed the S&P 500, or SPY, by 2.16% this week, and the relative chart is making a series of higher highs and higher lows. Biotech IBB relative to the S&P 500 late on Friday was outperforming by 1.68%, still maintaining a full-bore bullish look, making a series of higher highs and higher lows. Another surprise, Biotech in isolation was profitable this week, up 0.53% late on Friday. Full-bore, bullish, and healthy look to the weekly chart. What type of look does Biotech have during a major risk-off or fear-oriented period? It would look more like this. This is IBB in isolation in 2008. This look here is quite a bit different than the present day. If you're scoring at home, here are the final weekly numbers for these ETFs in isolation. All of these ETFs here, including TLT, posted gains for the full week and outperformed the general market. Why the gains in TLT is important. With the Fed on deck, if the market felt that either A, the Fed was going to raise rates, or B, that the rate increase was going to kill the bond market, we wouldn't expect TLT to be up 2.6%. As always, we'll keep an open mind about the Fed meeting. With a Fed announcement coming this week, on Wednesday, it's extremely important to remain flexible and open-minded. The previous charts do not tell us what will happen next week. They simply tell us that the observable evidence in some cases may look better than we would imagine if we didn't take the time to look at the charts. And when we have a mixed bag, it's best to simplify. Price will guide us and the market will guide us next week if we're willing to listen with a flexible, unbiased, and open mind. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currency, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shivako Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.